then we used a median analysis of about 40 analysts from FactSet on their target gold price going forward in the future. So you can see that a lot of analysts are projecting the price of gold per ounce to decrease in the future. This is buoyed by a massive rise in the amount of ounces of gold the company will produce in the future. So we're projecting that revenue will grow at 43% from 2021 to 2025 as new milling and mining capacity comes online. So some of the assumptions that drove our DCF valuation we're projecting that large top-line revenue growth going forward, like I was explaining. It is in line with their 5-year average. The company's been growing very quickly recently. And taking a look at COGS, we're projecting as the company grows, they're going to be able to take advantage of efficiencies of scale with a lot of that new investment going into better operations with regards to milling. They can realize a lower cost of goods sold, which will give them a lot more margin to work with, a lot more operating margin. Same thing goes for the balance sheet. We're projecting a more efficient business going forward. We're hoping that a lot of the company's new investments recently will turn out to be worthwhile and help the business operate a lot more efficiently. And like I was talking about, mining is a very CapEx-intensive industry, so over the last 5 years, they averaged 19.5%. We think a lot of that investment's been made now, so maybe less will have to be done in the future. And we're projecting about 16% per year going forward to support those new operations. So due to the nature of the margins available to the business, it was not cash flow positive, even in the terminal year, which resulted in a negative equity value, which we just net out as a $0 per share value.
So for our peer analysis model, we decided to compare IDR's enterprise value to projected total ounces of gold to the 3 competitors that we mentioned before. And when you take a look at the enterprise value per ounce, we can see that IDR is trading at a premium. And then when we average out their competitors' enterprise value to projected ounces, we get the peer group average, which is our multiple used for our